Speaking about this from the perspective of the company or the entrepreneur, I mean, one thing that we've found in order to kind of reduce kind of risk on both sides, or indeed to promote commitment on both sides, is as well as making equity investments in companies, to provide some form of, if you like, commercial side letter. So this may be in BP's examples, where we will create some form of joint development agreement between that company and a BP business unit, or it may be some commercial offtake agreement on the kind of presumption that the technology works. And what that can then do is to create quite a good sort of virtuous circle, because on the one hand, it's good for us as the kind of the venture investor to see that company having a commercial arrangement, and it's good for the BP business unit because they're getting the benefits of kind of new and exciting technologies or business models. So that's one way that we see we can manage kind of risk and equalize kind of returns across the piece.
Jin Yi?
I think I will speak more from a investor has China experience. I think China is starting to play a key role. They're, one of the portfolio we over the last year we worked quite hard helping them get the right partnership. I think the partnership, talking about partnership, two type, particularly for some star company has technical background, but one scale up in terms of manufacturing or the market. In China, government is a partnership. Finding the right partnership, working with a government is a key at certain stage of scaling up. And our experience on that front is local government in China. I think in some cases here in Singapore, government very active to helping startup company to overcome certain challenges, and find the right partner working. Find the right government partner has a certain challenge, also has certain risk. Government willing to put on capital, put on local support, helping the company, but in many cases they are not as helpful to some extent in terms of the way venture investors look at a company. Sometimes they back wrong company. Sometimes they create a very bad industry dynamics. That can happen in certain way in solar industry. Right now it's still happening. The bubble is still there. Also finding a good working relationship with the government also quite challenging along the way. Starting and along the way, there are many unknown risks along the way if you pick a wrong government partnership. The second type of partnership is industry partnership. Many local companies in China, they are hungry for technology, hungry for overseas market access. So they want to work with overseas technology company. Startup, they were willing to take the risk, and in return they get a technology overseas market access. But working with a local Chinese company has its own risk. Chemistry is very important. Align on the interest also very important. So that's two type of partnership we see, and understand the risk and benefit, and structure relationship is very important.
Can I just, when I talked about a dysfunctional board, the major reason why boards are dysfunctional is not that people are problematic, it's the alignment of interests. That's probably the most crucial areas. What's the expectation of a BP when they come in, for example? And it depends on the round of funding as well. And part of the problem is you came in at a higher price than we did. So we might be more inclined to walk away and just make 5 times our money when you're only getting a half of your money back. Or I'm not suggesting that that's the normal dynamics of 5 to 1 between an A and a B, and we tend to invest in the B round too, so that's very important for us to just know somehow you've got to structure the subsequent rounds of funding so that we're all voting for the long term. When is the exit? What does an exit look like?
Yeah, I think you're absolutely right. I've been at the kind of the tail end and at the front end of some dysfunctional board situations. It appears that strategic alignment is a kind of ephemeral thing. It can kind of go away as quickly as it kind of appears to arrive. I think our experience of kind of dysfunction has come in a couple of ways. One was the expectations of kind of multiples, when I dare say some of the kind of the partners got kind of rather, when an offer was put on the table, the partners, the investors got frankly too greedy and wanted to kind of hang on to the company, and things started to kind of go south after that. But I think that was in the kind of the height of the bubble. I think the particular investor group would have been delighted with the offer that's on the table now, given circumstances. So it kind of depends where you are in the cycle. But that's I think it's probably not unwise to take reasonable offers rather than hanging out for something which looks completely something that is delusional. And we've seen deluded boards thinking they would get a lot more for a company than actually was realistic. The other part of kind of strategic misalignment, and I'll kind of put my hand up on behalf of corporate venturers, is that what appears to be a kind of a strategic and aligned investment at kind of one time can quickly become not a strategic investment. So, for example, in the BP case, we've made a number of investments in solar, and we are exiting the solar business. It's quite hard to continue to justify following on those investments over time when BP strategically is no longer in solar. However, we say that as being a good investor and a good partner, you need to continue to follow on and support the company that you've started with, and so we need to ensure that we educate our senior management to that effect. It really impacts your kind of reputation as a corporate venturer if you're kind of in and out and in and out. So we try and stay the course.
By the way, I'm glad that you continue to support those companies even though the corporate mandate might change. The most dangerous things are when the corporate or an investor starts to block moves and insists that they get bought out, and they start to blackmail the company. And we've seen that happen from time to time. Again, not BP, but certainly other corporates have said this is no longer strategic to us, but we're not going to get out of the way. We're going to make your life very difficult unless you deal with us.
That's often been other two-letter companies that have done that. That issue comes twofold, is what Kevin's saying. It's not just the strategic change, but it's also the personnel change. So, you end up getting, for example, and I'll pick on GE, where we had the good fortune in one of our portfolio companies to have them as an investor. They came in very excited, and it came out of their power group. Well, by the time they'd gone through 3 realignments in 2007 to 2009, we ended up being managed by their capital group as opposed to the power group. And it was, the people who inherited it had no interest whatsoever. It was a very important deal to us at the time. Their $5 million was not the issue. It was really the pilot plant and all the other things that were really exciting to prove commerciality. And they just died when they didn't have an advocate within the power group. And that was probably the most disappointing side. And then when we wanted to sell it, and we've had this numerous times, the blackmail issue actually is a big issue.
And by the way, that's not unique to corporates. I mean, I can think of a few funds in the Valley that are playing that game where they've run out of reserves. Right. And they're starting to pick and choose which ones they're going to support. And when they've stopped supporting a company, watch out. So this is just a word of caution for the entrepreneurs in the room.
That's choosing your syndicate well.
Looking at one point Jin Yi made, from a different perception of risk, me representing a German startup company in the green building materials arena, we could be quite attracted by the idea of working with a big Chinese player, but 1 or 2 of our guys would be saying, hey guys, dangerous, what's going to happen with our IP and our formulations? So how can we overcome that limitation to potential partnerships?
Actually, that question always come out first. Either a startup finding a partner or multinational move to China. That question always come out first. But over the past 10 or plus years, I think lots of practice and also some very good practice, precipitate, and company know that how to, balance the risk of losing IP with leverage the capability of manufacturing in China, and also the whole supply chain. There are some practice, there are long lists, lots of experienced people knowing how to do that well. Some good practice compartmentalize all the IP. Basically, if you have material IP, isolate that part, in the operation. Only few people know that, and also, in terms of access to certain IP, only few people know that, and highly incentivize some local employee. If you need local employee working on the key part or as a key member of the local team, highly incentivize. And certainly put a good IP portfolio in China. That's very important. We see the IP protection in terms of enforcement is getting better and better. But risk always there. If you go to some other country, it still has the risk. But it's I think also experience out there.
Maybe I can open up the questions or comments to the floor. Otherwise, my panel is so dynamic, they'll definitely can manage. Our friend from Penang.
Hi, very good discussion. So my question is more for Mr. Jin Yi from China. Basically, I want to understand from your perspective, what is the risk appetite of China kind of VCs or venture capital investing outside China, maybe into Southeast Asia. What is your criteria? What you look for a partner that's outside China? Because I know that a lot of activities within China, but is there a trend to move outside into the rest of Asia? And what do you look for? And what technology sectors are you looking at?
I think there are multiple model Chinese investor, early stage or growth stage or late stage. They some look outside, invest 100% outside company and grow outside of China. But for us, basically two directions. One direction, any technology company can leverage China operation capability or manufacturing capability and can lower the cost. So that's one direction. And second direction, any technology company can utilize the Chinese broad cleantech market. On that front is not like IT. Cleantech has a very broad application in China. So any company technology focus, we focus on technology investment. So any company on that front, we did several investment in U.S. company, help them expand in China, either operation or market.
I mean, just to add, there's been a long history of that. If you go back to the mid-90s when I started, it was all about Walden and Vertex that were investing heavily outside of Asia back into the States and into Europe. More recently it was firms like W.I. Harper that we saw, or even today Sing Capital shows up regularly in my offices in London. So there's a real interest, I think, on the part of the Asian investor to look for deals outside of Asia, provided that they can add a lot of value to those deals by bringing those technologies, companies, teams back to Asia and build businesses here. So again, as the problems continue to rise in Asia, environmental problems that is, and the opportunities for companies grow, I think we're going to see more of that in the future.
As a financial-oriented VC, I see the corporate usually as my exit because there are no IPOs anymore. We have trade sales, and of course, I know that corporate VCs, have the policies about the Chinese walls between the investment arm and the business arm. Yet the reality can be sometimes different. I was at a corporate venture capital workshop in Brussels, where a consultant explained how you spin in knowledge of a portfolio company into the business of a corporate, which I felt was, quite unusual, let's put it that way. So what is the panel's view on working with the dual role partners, investor and also customer of your portfolio company?
One way we've found to ensure that this happens is actually to enshrine it legally, so that what we would put in place is, for a number of our companies, twice a year, for example, the venture company would have the opportunity to spend time with our interested business unit. That is described legally as to how that will happen. and it's up to the venture company to talk about whatever they want to our business unit without breaking confidentiality, because again it gets protected in a kind of sensible and pragmatic way.
I was just going to point out that there are different types of corporate investors, obviously. And what I mean by that, for example, you know the company well because we've been talking about it. We have a specific technology company, and we could either let the service provider invest that could promote the technology and deploy the technology, or we could have an end user customer invest in the company. And those are two very different types of investors that we could bring into a very specific situation. So I think knowing what the corporates can bring and knowing what the conflicts of interest are help you select which corporate you want to work with ultimately.
Let me just add to that. And one of the, we actually do have rules occasionally that we follow. And I'm not saying that sarcastically. I mean, we try very much not to have very specific rules. It's more like guidelines. But one, we will not do a corporate deal where the corporate company will own more than 20% of the company. And there are a whole bunch of reasons, but we really like to see it somewhere between 10 and 15%. And that has two issues to it. One, it's valuation, because we might need their equity, and the company may not be worth more. You know, so there's that side. So you have to be very careful. Maybe you put it in as NRE rather than equity, non-recurring engineering expense. And we will not give rights of first refusal. So those are two things that affect both how the company manages, how we are managed by that company as a portfolio company, and exit. And again, apropos of what Dominic is saying, that can be done all up front because you know you're putting in that sort of caveat, no right of first refusal, in the term sheet. Even before you even get to a negotiation, you're talking about maybe get them right of first offer. But really, they've got the knowledge of the company. If they want to acquire it, they're going to be able to do that before anyone else does anyhow. And the rest really comes down to proper governance. And you don't want, we're here, including the corporate, to maximize your return on that investment. And you're actually going to minimize that if you have a higher number.
The red light has been flashing. We are moving closer towards the end of the day. I would like to give all of our 4 panelists 30 seconds to tell us what is their green tech pick that they think in 10 years' time will be a major home run. I guess with Peter, it's some kind of insect protein manufacturer. No, just kidding. But give us your crystal ball reading. Where are pockets where you think, wow, that could be a home run? 30 seconds. Peter.
I would say a digitally enhanced. I love what we're doing with agriculture, but I think what we're doing with digital sustainability is probably even more exciting in terms of dollar valuation issues. We have a company that is reusing and recycling cell phones, for example. It's grown by 70-fold. We'll do over $700 million this year in a 3-year time frame. So I would say what my crystal ball is the use of digitalization to change old world industries. And that can be our food industries, it can be our health industries, it can be our power industries.
Thank you, Peter. Robert?
I think along a similar vein, what I would pick is as one looks at these complicated global supply chains, I think people are very interested to understand today where their food is coming from, where their products are coming from, and software solutions to help people understand that, identify that is going to be really important going forward.
Thank you, Robert. Jin Yi?
If we talk about 10 years, I think the transportation transformation will be a key phenomenon in 10 years. You know, I'm speaking part of China experience, but globally, China will play a key role, but this won't be a near-term opportunity at all.
Dominic?
And maybe I'll go beyond 10 years and talk about carbon capture and use. I think there are real opportunities there for taking carbon dioxide out of the atmosphere and turning it into kind of fixing it in useful products for the future. It may be something of a kind of a pipe dream, but far better than to stick it underground although we'll need to do that as well if we're serious about attacking the CO2 levels in the atmosphere.
And those type of products, by the way, we agree with you completely on carbon. And I'm sorry, I know we're out of time, but carbon is such an important issue, and all you have to do is read this morning's paper about the fact that the price of carbon has just dropped because there's just no desire on the part of any government or the elected groups to put a real price on carbon. So until that's there, no technology, and we've had fabulous technologies for this, has a commercial chance. But that's absolutely, there are a lot of viable products there.
All right, thank you so much. A big applause for our final panel.